All right. Should we move on to Brett's final segment here? He's going to look at leveraged ETFs. We get questions about these almost on a weekly basis in our chat sessions and just via emails, and average investors talking about them via your Stock Car Taker or our podcast communications. So Brett's going to tell you what they are and whether or not potentially they are a good fit for the average retail investor.
Yeah, so like Ryan was saying, and it's not even just from our clients. These couple of advertisements I have up were just ones that I personally got delivered on Reddit, and I've been seeing them elsewhere as well. More and more of these leverage ETFs and just more generally structured products. So you'll see those covered call ETFs and enhanced returns where they combine actually both covered call structure over a leverage. Normally it'll be like 1.25, 1.5 times. So you're getting these more complex products in an ETF form, and they are more complex than what they can be on the surface. So you'll see here just right front and center, 3x daily leverage. You can really get that promise of 3x returns. Daily is very key to this, and even though most people who are going to be getting at the advertisement might not understand why that daily wording is so key, I've been seeing a bit better, because I have been following these for a few years now, a bit better disclosure on some of these ETF websites, but they're still not perfect. They still want your money at the end of the day. So let's really look into these. They've been just advertised to the masses like insanity at this time, like you can see with the ads here. And despite having these unique risks, they aren't, and seemingly straightforward structure, they aren't actually straightforward. They do have complexity to them. They offer normally 2x, 3x, and inverse variations, so short variations, so a negative 2x and a negative 3x. And the big benefit of these leveraged ETFs is just easy access to leverage instead of playing with options, futures, and margin loans. It's just a much simpler, easy thing. You can buy it and trade it like a normal stock. And that is the selling point to them. Bundled in a nice and packaged up easy scenario. You don't have to manage your leverage. You don't have to manage your loans. You don't have to manage the future margin. It is just so much easier. And that is really the big upside of these. So if you don't know what a leveraged ETF, or really familiar with leveraged products in general, if the leveraged ETF is tracking the S&P 500 index and that returns 2%, a 3x leveraged ETF returns 6%. If the S&P 500 loses 2%, the 3x ETF loses 6%. Nice and simple leverage. Further, if you want to short the S&P 500, there are nice and easy inverse ETFs, eliminating the need to manage a short position, which can be appealing, especially for some of the single stock ETFs, because they can be hard to borrow at times, resulting in higher fees, and that can just be easier for individual investors. The benchmark asset, it can be effectively anything. Before I was saying the S&P 500, but it can be a commodity like gold or oil, cryptocurrencies like Bitcoin or Ethereum, or even single stocks like MicroStrategy, NVIDIA. The big tech ones, those big American stocks, are generally the ones with these single stock ETFs are focused on at this time, but I would not be surprised if they start to move down the market cap. Effectively, the leveraged ETF structure can be used against any asset, which asset managers love, since they can create a myriad of different ETFs to increase their assets under management and therefore their fees, which are not cheap. For leveraged ETFs, they are actually quite high. So you can look at SPY, one of the longest standing, if not the longest standing American ETF. For the US, it is actually the longest standing, but not globally, but I digress. So it has a fee of 0.09%. A 3x leveraged S&P 500 ETF, SPXL, is at 0.93%. So that's over 10 times the management expense compared to the standard SPY. There are some lower ETFs these days. FU, I think, is 0.03%, so even lower. But the leverage ETF is just adding on that fee. Or if you compare Bitcoin, IBIT, one of the most popular Bitcoin ETFs, 0.25% compared to BitX, a 2x Bitcoin ETF at 2.38%. Once again, nearly 10 times more. You do have like SOX and SOXO, which it's about just under 3 times. But the point is, the fees are a lot higher. The trading costs are higher, but the management fund fees are also higher, and they get a bigger piece of the pie. So they love them. These asset creators just love them because they can advertise 50 different products in a very relatively simple solution for them and get their fees in. So the big structural drawback between, because I really was pumping up the benefits of them in that first slide, what is the downside compared to other leverage methods? Leverage ETFs, it's volatility, decay, or drag, and as well as path dependency nature returns. I know it's shocking to some people on the internet, but stocks and broadly more financial assets don't just go up in a straight line. They can go down at times. Even if they go up over the long term, they will go down during periods. And due to the general daily resetting nature of leveraged ETFs, which the mass majority of them are, there's only a couple which are longer periods. Once you go into multi-period returns, they will not match the advertised leverage amount. To the fund's credit, they do normally disclose that quite up and center, very top first line type of thing, but it doesn't explain really why. They are getting a bit better at it, but it's still not to the depth which most people would need to really understand the problem with holding these over multiple periods. If it's meant to be a 2x ETF over a year, it is not going to be 2x. Sometimes it can be more, but most times the return will be much, much less. So we just use a simple example before getting into some real world returns. First, to look at volatility in pairs. We can look at a week of trading, 5 days, comparing two asset paths. So doesn't matter what the asset is in this case, because we're just examining the structure, starting at $10 with two very different degrees of volatility. Path 1, the asset goes up $1, then falls back down to $10 and repeats. And then path 2 does similar, but instead of going up $1, it goes up $2 and then falls back and repeats. At the end of day 5, path 1 ends up at $11 with a volatility of 10.5%, with path 2 ending at $12 with a volatility of 20.1%. That's something you'd expect in normal assets. Is the higher return is the higher volatility. There's your market efficiency. That is something which you would expect to happen in the real world. But you can't expect the levered ETF of path 2 to actually outperform. It's just not the case. Path 1 had a cumulative return of 16.2%, where the levered path 2 return only returned actually 2.4%, the worst return of all four in this table. So if you're comparing the two companies in this case, so path 1 is company 2 and path 1 is company 1. Company 2 was the better investment in general, but once you're layering that leveraged ETF to maximize return, which you might be directionally correct in this case, but you were so negatively impacted by the volatility, your end return was actually the worst option of the four. So you not only need to be directionally correct, but also overcome the volatility. The lower the volatility, the better for these leveraged ETFs. So if you have a straight linear return of the underlying asset, that's the best case scenario for these leveraged ETFs. That's just not a real world scenario in effectively any means or in any case. Further, I will note that the higher the leverage, the higher volatility, decay, or drag, that will impact the ETF returns. So a 3x ETF will be impacted more than a 2x ETF. In a similar manner, it just magnifies it even further. Next, we can look at the path dependency. In this example, we can once again start $10, and the assets both actually end at $11 over the 5 periods of trading. Path 1 increases or decreases by a relatively random amount. I just put these numbers in to make the volatility or the standard deviation the same. Whereas path 2, it goes straight from $10 to $11 and just stays flat after that. The volatilities of these assets or standard deviations are both 4.47% for both paths. So same volatility, we're eliminating the volatility, drag, or decay. If you just held the benchmark asset, the return is the same at 10%. But the 3x leverage ETFs are different. Path 2 rose by an expected 30% since the entire return happened in one day. Whereas path 1, with its random movements yet same volatility, only gained 29.36%. You might say that's only a minor 0.64% difference on a 30% return, but this is only a 1 week period. If we saw this recur again and again on a weekly time frame, it will compound over time, just creating a further drag on returns, completely irrelevant of the volatility. Now we can look at a real world example. Brennan's personal favorite, I believe, MicroStrategy, MSTR on the NASDAQ, and its 2x leverage, or one of the, I should say, just all the different asset creators are just diving into this one, and as well as other big American tech companies. 2x leverage companion MSTX. We can see on the 1 year time view, MSTX did actually perform at the start. When Bitcoin surged in November last year, we saw it actually outperform MSTR or MicroStrategy. But once that euphoria was gone, MSTX significantly underperformed. And that was really the asset during that time was relatively flat. But MSTX, just because of the volatility, decay, and path dependency, actually ended up losing 47%, roughly half, over this 1 year period, despite MicroStrategy returning a positive 59%. So you were directionally correct, but due to the volatility and path, a winning position actually turned into a losing position. And this is more common than not for these single stock leveraged ETFs. Despite being a strong market, most are actually underperforming the underlying stock and or similar returns over this last year when the spot checks ones, which I've done at least. And some you'll see they vastly outperformed for the first 6 months, but then the return came back down and they're actually mirroring return. And this has been a pretty good year, even though we did have, obviously April was a poor month, but we're still up quite a bit through just broad market indexes throughout the year. And these, of course, can result in periods of outperformance. As you can see here with the MSTX, there was that November-December period, which was outperforming MSTR. But over the longer period you look at, the more likely it is going to be underperforming, as stocks just don't go up in a straight line. I know that hurts some people's opinions on the internet. Stocks don't just go up. So in summary, leveraged ETFs do have their place, but it's a trader's place. It's not an investor's place. They offer simplified leverage for short-term. Best use is intraday, so within a single trading period, as you don't get that volatility decay in any sense. They're just not suitable for long-term investors. You can cherry pick some better periods, but if we do see ever a flat market, even on a broad index, you will underperform, even with taking into consideration the 2x or the 3x return. Even if it's slightly up, it can underperform. You have higher management fees, which further increase the drag. That's straightforward. But then you also, of course, have the general risk with leverage, which I didn't go over here. Higher return volatility, increased losses, or the chances of loss as they are magnified, just in general. And you'll see that regardless of what leverage products you're using. But further, you see that volatility decay. That is the biggest factor. Higher volatility will create a massive, massive drag on returns. So if you're thinking of using it for something like a hedge, you're buying an inverse ETF, a 3x inverse ETF to hedge your portfolio. That makes sense, right? But the problem is, once the broad stock market, we'll use that for example, an S&P 500 inverse leverage ETF. Once that starts to go down, volatility increases. It's not going to go down in a straight line. It will go down 5%, go up 2%, go down 5%, up 4%, and so on. And that will actually just eat away any return you've even had, because volatility actually decreases or increases as the stock market generally decreases. You have those volatility clustering periods. So even in that hedging period, you can't just use this tool as a hedging tool really over the long term, only short term, very short term. Further, the path dependency, even though it's not the greatest drag compared to the volatility decay, it does actually matter, because even if you are even right on volatility, the path still does actually matter. It's just an added layer of complexity, which is why for probably 99% of investors, you should just not even consider these products, despite what the asset managers are continuously advertising to me, and I'm sure many of you. And that's where I'll close off. If you guys have any thoughts.
Yeah, I'd just say for further reading, to check out your article, which you just wrote on our website, on our blog. You go a little bit more in depth, just on leverage, and just kind of your examples as well. So, that is a good read for further reading. And again, just to emphasize, you said it, but these leveraged ETFs are they're tools for traders in the short term. They're not long-term investment vehicles. You can be right on the direction, but that volatility decay is going to eat up your returns. So you need to keep that in mind.
Yeah, I would say if on those single stock leveraged ETFs, the example was great on MicroStrategies. And I think if you asked most people, if you invested in a 2 to 3 times ETF on a single stock, and that stock was up 50% in a year, you definitely would think the average investor would probably say that you'd definitely be up in that investment on an annual basis. But shockingly, I mean, it isn't really shockingly, but I think to them, when you lay that out, you show them the chart on MicroStrategies, in most cases, the stock unless the stock went up in a straight line, which stocks don't go up like this, but in most cases, you don't beat the individual stock investment just in that company. You'd actually be down significantly. You can be losing significant money. Even again, Bren, we keep saying this, you can be completely right. The stock is up 60% in a year, and I bought a leveraged ETF on it. I should be up 2 times that. Well, no, that's not the way it works. They're short-term vehicles, right? And I mean, they are advertised like that. They are stated like that. But I think when people look at, you get 2 times the S&P. Well, would say most would think in a year, if the S&P is up 10%, I'm going to get 20%. Maybe they don't, but I've seen investors with far less complicated products not understand them. I would say there's likely a high degree of people that just don't understand and just not understanding these products and what the potential downside. And I think it was laid out there well. And we're going to keep talking about that because I know that many of our clients who even understand what investing in an individual stock is and the valuations, they don't understand these leveraged ETFs, generally speaking.
But yeah, like even looking at myself, back in university, 100% right, Ryan. Like just like what you said, it's like I thought that it would be my return was going to be 2 times, the return on that asset, if I held it over the long term. Obviously, I've learned that over the years that that's not the case, but I think
I don't blame the lay investor.
Exactly,
like, how
it's a
should
very
we?
common misconception. Yeah.
I mean,
it's a marketing.
I'm not going to name any names. I was at dinner a while back, and there was some bunch of financial professionals there, and didn't understand at all what these were. So how can we understand? How can we expect the lay investor to understand these?
Yeah,
no,
some will for sure.
Especially when they're advertising the way they are. I'm seeing that more and more. Some of them are fine, which they'll actually say, but that keyword is always daily, and I don't think that will click for 99% of people unless you already know what it was. No. And I think that's the key thing is they're covering their own asses, whoever the advertiser is, whatever fine creator, but it doesn't actually convey what the actual risk is really.